this session, we are going to introduce the concept of analysis. Please, if you haven't done it yet, read the disclaimer. So, when we talked about the framework, we talked about 4 different elements that we should consider or have it into account. In this session, we are going to introduce the first of them, the analysis, that it should take approximately 30% of our effort. So, the main quote or the best quote that defines what we make when we follow the value investing philosophy, in my opinion, is this one, that price is what you pay and value is what you get. That was said by Ben Graham, that is considered the father of value investing. And this is because it makes a real distinction between what is price and what is value. So, when we talk about price, we talk about the market price. We talk about the price at which we can buy or sell stock at a given moment in the market. And this is something we can objectively see, or at least we can propose or we can put an order at a price. And if it is okay for the rest of participants, for the sellers and buyers, they can take it and we can make the operation. On the other hand, we have the value, that this is more subjective because depending on who is valuing it, it can give it a different amount, a different value. So when we talk about intrinsic value, we talk about based on the fundamentals, based on the business and or the different assets that the company has, we are going to calculate how much should be valued for, what should be the price of this stock. And when I say that it can be different depending on the different people, it's because it is so different to value the different aspects of a company, and it is in fact depending on what is going to happen in the future, that depending on the estimations or depending on the assumptions that we make, we can have different values. Of course, they shouldn't be very different, but sometimes, and depending on the company or in the sector, they can be in fact very different. So we cannot know if a stock is cheap or expensive if we don't have at least an estimation of its value. We cannot know it only checking the past prices or knowing the current price. We should make an estimation based on the business, based on the reality of the industry or in the economics or in what we think is going to happen in the future in order to estimate what should be the price of this stock. So imagine we have a listed company that is divided in N shares. In one hand, in the left side, we have the stock market in which we have the share stock price. If we multiply this share stock price by the number of shares, we can get the market capitalization. On the other hand, if we value the company, if we take the financial statements and the current situation, the industry in which it is operating and what we think is going to achieve or to earn in the future, and divided it by the number of shares, we are going to have the value of a share. So these are the two amounts that we need to compare in order to know if a company, if a share stock is undervalued or overvalued. So we can have 3 different possible cases and we can have different actions to do depending on if we have a stock in our portfolio or it is not yet in our portfolio. So it could be that the price is higher than the value. So in this case, we could say that this stock is overvalued at this price. And if it is in our portfolio, we could consider or we should consider to sell it. And if it is not, we shouldn't do anything. We should just ignore it. If the price is approximately equal to the value, we could say that this stock is on price. And if it is in our portfolio, we could decide to maintain it or sell it. We could decide that the value is going to increase in the future, so we decide to maintain it unless it is overvalued. If it is not in our portfolio, normally we are going to decide to ignore it. If the price is lower than the value, in this case, it is undervalued. If it is in our portfolio, we could decide to maintain it or buy more of it. And if it is not, normally we should decide to buy it. So here, in this difference between the value and the price, is what we call the margin of safety. And as higher as it is, the better for our investment, because that would mean that this stock is more undervalued, so it is a better investment for us. So if we see this in a chart, whenever we see the market price in a chart, we see something like this. In this case, this stock price is growing. It could be that not, but in this case, just for this analysis, we are going to assume that it has a curve, a line, something like this. And on the other hand, if we calculate the value at each of these steps, we are going to have a line as this one. As we see, this is a different line because it has some constant periods in which the value doesn't change. This is because we are not going to change the value of a share, value of a company, if we don't have new information. So whenever we get new information, we can decide to update the value. So in this case, we can see that as the time goes by, we are updating, or we are making higher the value of this company. Normally, this is going to happen quarterly whenever the results are released, or it could be that because there are some information, some new information as a new acquisition or whatever, it can make us to reevaluate the value and then to update it. And as we see with this, there are some moments in which the value is higher than the price, and as we saw, this difference between the value and the market price is what we call the margin of safety. So these are good movements for buying this company, this share, because normally it should go back to the value, so we could get a gain in this investment. So as we see, there might be some periods in which the price is higher than the value, so we might ignore this stock, and there are others in which the price is lower than the value, in which it is a good moment to buy them. When we talk about the valuation, it is important to know the concept of free cash flow. Sometimes it's called owner earnings. And this free cash flow, it is what is available after the operating cost and maintenance capital expenditure. So whenever a company sells, it gets a revenue for these sales, and after deducting the operating cost and the capital expenditure, the machines or plant that we need to use for getting these revenues, we are going to get this cash flow, that is the free cash flow. And this is what can be considered the free cash flow that is available for shareholders. In fact, it is not, because only the dividends are going to be explicitly paid to shareholders, but at least this free cash flow is going to reinvest it in the company, or it can be used for reducing the debt. So somehow it is like a shareholder earning or a shareholder cash flow. So this is important because in order to calculate the value, this is the main figure or the main measurement that we should take into account. Whenever we want to value a company, imagine that we have the free cash flows, in this case, in the period of time. We could use different metrics, but in this case, we are going to use the free cash flow. So imagine that this is the moment of today. So first of all, we can see in the financial statements the past, what was the free cash flow in the past. Sometimes we have to adjust it to get the real figure that we want to use, but this is a given information that we already have, and that is going to give us the story of this company. When we say this, we mean that with this financial statement, with these free cash flows in the past, we can understand what happened, and with this, what is important, and with this analysis, we can understand the key factors that are going to cause what is going to happen in the future. Because what it is important is that with this analysis, we should be able to estimate or to forecast what is going to happen in the future. And this, and only this, is what is going to give us what is the value of the company. So this is why it is so important, this analysis, because the only way of valuing a company is somehow estimate the different cash flows that is going to get in the future.